I don't think that bank regulation is very complicated. I think at the end of the day, what backs up a bank is its capital position. We have a lot of rules that are very specific about trying to get risk weights right for what a bank is doing, or trying to ensure that there's enough liquidity in a bank and so forth. At the end of the day, always matters how risky a bank is, it's its capital position. And so one could actually solve the problem of banks taking on too much risk or being too fragile very simply by checking up the capital position significantly for many banks. I don't think that the capital regulation, if we have much higher capital, it would actually stop banks investing or intermediating financial markets. I think there's a misconception. More capital would just mean basically more funding for the bank, and that would be actually productive in expanding its financial intermediation role. So in a sense, more capital would mean more funding for the banks, which allows them to intermediate more assets in terms of giving out more loans. So there's a misconception out there in the market, or like in the policy community as well, that tougher capital regulations will actually restrict the operation of banks. But this is really a confusion about the asset and the liability side of banks. There's a huge resistance against raising capital requirements. Why? Because it doesn't allow banks to do what they would like to do, which is having a high leverage. The issue is with high leverage, they don't put any of their own money, so to speak, at risk, but they have a huge upward potential if things go right. The downward potential is very minimal. They have no skin in the game, they have little skin in the game, and on top of that, by being highly leveraged and also fulfilling a social function for intermediating credit, they basically playing the game of being constantly bailed out by public authorities or the state or the government.
Okay, thank you very much.